Hi there, this is Christian Dye from Latitude West, and I am presenting today. I've got my partner Faisal with me, and we're presenting on Investing 101. This is stocks, real estate, and starting your own business. We have a lot of clientele who are either dentists or physicians or, self entrepreneurs. And so what we want to do is we want to bring it all together and give them the very, very basics. Um, Quick disclaimer, the information given today is not to be considered as stock, real estate, or business advice. We advise that you do your own research, work with professionals, only use the information we're giving today as education for educational purposes only. So here is a quick snapshot of my team, and Faisal is here. He will, of course, help me to moderate, answer some questions at the end. My partner Joel is actually in meetings right now. My assistant Vicky is under the weather, and my other two assistants are always happy to help when we have clients that need it. A little background about Latitude West Financial. I started the company a little under 20 years ago. It really started as an insurance-based practice, but then we transitioned into investments. And then I sort of married my love of real estate into the practice. And now many people rely on me and my team for our business advice as well as our real estate advice. So our business model is very similar to a traditional financial practice. We're insurance license, investment license, but we really like to focus on the planning because so many people need advice when it comes to the type of planning, whether they're starting a business, buying their first piece of real estate, investing in the stock market for the first time, incorporating. And then what I guess probably makes our practice most unique is our love and acquisitions of real estate and helping our clients to buy more real estate or buy more businesses. So we're very business friendly, real estate friendly, not just stock friendly. Okay. So what I want to do is I want to dive right into it and ask a couple questions and then answer them myself. So if you have any questions, please just save them to the end and we will field all of them because there's a lot of material and I want to go through it as fast as possible. How do the ultra wealthy invest their money? That is my first question. I want to start with a group called the Tiger 21. It'll help to give us a frame as to what our philosophy here is at Latitude West. The Tiger 21, if you've got an opportunity to ever research them, they were a group of self-made multimillionaires. The very first person who started the group, sold his tech company, had hundreds of $1 millions, but didn't really have a lot of places to go in order to get good advice, in order to figure out what the ultra wealthy were doing. So we started this group, and then all these other people who were in a similar situation started to invest in it. So because these guys, of course, work with the absolute best and the brightest, then shouldn't we be looking to them to say, what do the absolute best and the brightest do? And I'll tell you right now, they do not stick all of their money in mutual funds. Okay. So the Tiger 21 asset allocation, if we look at it, about a little under 7% is in the stock market. So less than 50% of their assets are actually in direct equities in the stock market. About 31% of their money is in real estate. And we're talking real assets right now. Like these are apartment buildings they own. This is land that they own. These are shopping malls. These are, condo developments. And then this is the fascinating part. About 22% of their assets are in very low yielding fixed income or cash. So most people don't hold on to that much cash, but if you take a look at guys like Warren Buffett, they have very similar asset mix. So how could the Tiger 21 produce such high results with this asset mix? And that's what we're going to talk about today. The other group I want to talk about is the Canada Pension Plan. Believe it or not, for us Canadians, the Canada Pension Plan is one of the best pension plans in the world, one of the best managed ones in the world. Right now, the Canada Pension Plan has beat the S&P 500 by 56%. Right now, their annual rate of return is about 12.48%. Okay, so the Canada Pension Plan is doing an incredible job for Canadians. And let's dissect what they invest in over here. So let's understand what is the difference between a 12% return and, let's say, an 8% return or a 4% return, okay? So now I want to talk about IRR. That stands for the internal rate of return, or you might understand a little better as, the rate of return. So if you said, I got 8% return on my stock, if it was tax-free, like in a TFSA, then your IRR was 8%. But if it was in a non-registered investment and you made 8%, then if you were to utilize and sell this stock, you might only make 6%. That would be your IRR. So it's the internal rate of return. So just a quick little reminder, my background is in mathematics and in finance, so I'm a big numbers guy. So I'm going to put on my math hat a little bit and give you guys a little math lesson. If you were to invest $100,000 for 40 years and you had an internal rate of return of 4%, you would have $480,000. Okay, not bad. But what if you had 8% return? You'd have 2.172 million. Significant. You might say, well, that's double the return, but it's significantly more than double. It's 5 times the money, right? Even though it's only double the return. If we were to get a 10% return, that's only 2% more, you'd have a 4.5 million. Now let's talk about that, Canada Pension Plan. They're getting about a 12% return. That would be a $9.3 million. So you see the exponential growth by just a few percentage points makes. So I'm going to keep harping on the IRR because I know some people that are listening are investors, and I want them to understand how can we improve our IRR and why is the IRR so important. So Canada Pension Plan is doing so well because of their investment mixture. They're actually 7 years ahead of their projected schedule. That's how good they are doing, okay? So we say, well, what is getting that 12%? If we break down what Canada Pension Plan's asset mix is, only 56% is actually in equities. They have 23% in fixed income. That means little to no growth over here. We're talking like cash and fixed income. But in real assets, 21%. These are things that they actually own, apartment buildings, these are complexes, these are shopping malls. So my big question is this: if the wealthiest people and the wealthiest institutions on the planet have this mixture, then why don't we? And here at Latitude West, this is our philosophy. This is the philosophy of our breakdown. So I want to talk about how do you increase IRR? Taxation, obviously, and our team is very proficient in how individuals can improve their tax situation. Leverage utilization, that's where a lot of this real estate comes from, and we're going to talk about that. We could leverage bank money in order to grow our assets, and we have significantly higher returns when we have something called cash on cash returns. Corporate strategy, when our income as individuals breaches a certain amount, we start to look at incorporating it in order to shelter some of it, the taxation, and then we could draw from it and invest through it through operating companies and holding companies. I wish this talk was longer so I can go into great detail, but maybe if anyone wanted to talk afterwards, I'd be happy to explain that further. So we're going to look at stocks, we're going to look at real estate, and we're going to look at business, all as tools to, of course, see what their IRRs are and how we can increase them. So let's shift gears to stock investing. We'll go stock investing first. So here's my question. How do you compare two different stocks? How do you compare two different stocks? So we're going to look at a couple of different metrics. We're going to look at a growth versus a value stock. We're going to look at revenue growth, price to earnings, price to book. And in the next 10 minutes, I'm not going to turn you into stock experts. All I'm doing is showing you some basic fundamentals for you to consider, some basic fundamentals for you to, think about. And again, by no means am I telling you to do this. I'm just teaching you on what people do when they're evaluating a stock from the basics. Okay. So growth or value. So we could almost categorize, every stock into a growth stock or a value stock. Okay. And then of course there is some lap over. And then there also is a category where you might not put them in either, but most of stocks can be thought of as, am I looking for growth or am I looking for value? So growth is pricing is based on the revenue growth. They might show little to no profit, but we have such, we feel that it's such a big growth stock that we're going to put this in place. So a tech company like Tesla, that would be a classic example of a growth stock. And for those of you who do hold Tesla stocks, and maybe bought it, let's say 5 years ago, you understand what it means by this kind of exponential growth. Value stock pricing is based mostly on current profit. How profitable is it right now here in 2022? Banks are really good value stocks. Very, very mature companies would be considered really good value stocks as well. So we're going to use Tesla as an example. So if no one has ever, analyzed a stock, these are just some very, very basic, just some great starting points over here. So you can go to a website like Yahoo Finance and you could pull out their financial history, just go to their statistics. As of today, as of yesterday, this is what Tesla was trading at. So I'm gonna grab a number over here, and it's the price to earnings. So I go to their statistics, I go take a look at what their trailing price to earnings are, and this is looking backwards. Forward price to earnings is looking forwards. So if I take a look at price to earnings, where do they come up with this number and how is it relevant? So if you have the price of the value of all the shares is 573 billion when this slide was created. It's a little bit different now as of today. But if you were to essentially take, okay, what is the current price of the stock and how many shares are outstanding, multiply those two numbers together, I'm going to get $573 billion, okay? Then earnings is the amount of profit, and then they have to, of course, record what was their earnings for the year, and we would say they earned 9.5 billion in 2021. Their price to earnings would be 60. That's how they get the number. Now, the S&P 500 has an average of 20. So if they take all 500 companies and they average out what is their price to earnings, they're going to get the number 20. You essentially want this number to be as low as possible because, of course, you want profit to be high and you want price to be low. So you want the numerator to be a low number and the denominator to be a high number. So is 60 a low number? Absolutely not. That's a huge number. Now, if you want to try to understand this from, how much the company is earning, how much you're earning per year, we would inverse this. So again, throwing my math there. So 1 over 60, this over here is now going to be earnings to price, would be about 1.7%, which means annually for every $100, for every $100 of shares, the companies weren't earning about $1.70 per year. So that means what will they do with the $1.70? Maybe they'll pay you as a dividend, 1% dividend, pretty low dividend. Maybe they'll take that $1.70 and maybe they'll put it into R&D, research and development, create something new. Maybe they'll just take it as cash flow and then keep it in their account. So for a company like Tesla, you'd say, well, that's really, really low. That's right. It's because they have very low price to earnings. But it's nice to compare price to earnings when you're comparing one tech company to another tech company. You, of course, want this number to be as low as possible. So you wouldn't want to compare this to something in a different asset class if what you are looking for is growth. So now let's take a look at the revenue. And this is so this 55.9. This is where we're going to get what is their growth rate. So we go to the income statement, we grab the quarterly revenue growth rate. This is year over year, so it's like Q2 to Q2 or Q3 to Q3. So 55.9. What me and my team did is we took an average, and the 5-year average was about 50% for Tesla. So that means that their growth rate is about 50% per year of revenue growth. So that's insane. That's so high. So the company that the company that I want to compare it to, the value company, is RBC Bank. So their 5-year average growth rate is 5.7%. So we have 5.7% compared to 50%. Okay. And if you take a look here in 2020, they had all these negative years on the RBC revenue growth rate. So, so that's a great comparison between a value and a growth company. Let's go back and look at now price to book. Okay, so price to book. So Tesla's price to book is 14.52 at the time of this recording. So price to book is where you take, again, the price, the value of all the shares, so 573 billion, and then we divide it by the book value. And the book value is if I was to take all of Tesla's assets, and if I was to subtract it from all its debts, this over here is what the company is, if they have to sell everything, if they close shop and they said, I'm just selling out all my assets, they'd only have $40 billion of assets, even though they have 573 billion of shares that are out there. So if Tesla ever closed shop and you're holding on to Tesla stock, you're going to pretty much lose most of your money over here. Okay. So you want this number to be as low as possible as well. You want this to be as low as possible. So, the S&P average of price to book is 3.8, Tesla 14.3. So, the more book value a company has, it tends to be the safer the investment. The safer the investment is. Now, they might not be growing a lot, but you do know that if they were to collapse, then at least you'd probably get all of your money back, or if not more. So Tesla has a low book value. So it could, because it has a low book value, it would be considered a fairly risky investment, because what you're doing is you're basically gambling on capital appreciation. So if you were to compare this to real estate, you might say buying a condo in Yaletown, Vancouver in 2016, well, the cash flow would have looked terrible, right? But you're looking for growth. You want the growth. And comparing RBC, you might say buying that same condo in, let's say Saskatchewan, where the price to replace it, the price to replace the condo itself is more expensive than the value of what it's being sold for at the time, which means that the value is there. Now, that property in Saskatchewan might not be growing a lot, but you know that you're not going to lose money on the investment itself. Okay. So a quick little example, Spirit Airlines in 2020, of course, COVID hit, no one was flying. They had a price to book value of 0.7. So anything under the number 1, if there's a crash and you believed in the company, that means if they went broke and they collapsed and they just sold all their assets and gave the shareholders back their value of the shares, you'd actually be making money if they went bankrupt. So that goes to show you the way price to book works a little bit. Okay. All right. So we want the fundamentals. The lower number is going to be the better. So if you're looking for a growth stock like Tesla, these numbers are high. 55.7, price to book 14.3. If you're looking at RBC, 12 is their price to earnings, and price to book is 1.9. Put these things together, how can we compare the two? The conclusion, if Tesla can maintain its massive growth, it's priced quite attractively. Tesla is going to be a higher risk investment because maintaining the growth is unlikely, whereas RBC's earnings will be consistent. So I'm not saying sell your Tesla or buy RBC. What I'm saying is this is just one fundamental way. If I was to dissect Tesla on its own, you might say, well, they're sort of dominating. They're dominating the electric luxury car vehicle. But pop quiz, who is thinking of entering into that market? And the answer is Apple. If Apple enters into the electric car vehicle market, just gave you a little hint about Apple. The last time Apple entered into a market, it was the cell phone market. And guess how they did? So they were a late comer to the cell phone market. Samsung was already ahead of them. BlackBerry was already ahead of them. And they're a computer company. And they said, you know what? We're going to enter into the cell phone market, and then we're going to see how we do. And then Apple also said, you know what? As another industry, we're thinking of entering into the music, online streaming. We're going to develop this little thing called the iPod. and look at how they did. So you got to be careful with these tech companies over here, because if a large player, someone strong enough comes in, they could be biting off a pretty big share. So that over there is a very simplistic summary, really basics of investing, comparing two different companies. You got to be very, very careful. To be honest, to be very, very transparent, I actually advise all of my clients not to invest in individual stocks. Okay, just to be transparent. Okay, my next question: should you invest in the stock market when it's down? Should you be investing when it's down? So the quick answer is it depends. It depends on your level of it depends on number one, like, where is this capital coming from? Is it cash? Are you leveraging it off a line of credit, or and what's your faith in the market, and what exactly are you investing in? So some people, they think that when times are good, they're going to stay good forever, and when times are bad, they're going to stay bad forever. And people believe that in the real estate market as well as in the stock market. But I wanted to show this graph about the S&P 500 composite during various different geopolitical events. And at the time of this filming, we are, of course, the war in Ukraine is happening right now. So one of the things that we're going to notice is that the S&P, which is the black line, whenever there has been a major geopolitical event, the market has always reacted negatively. But over time, it has always gone back up, and oftentimes it wasn't even that the war itself had ended. So I'll give you a perfect example, 9/11 here. When 9/11 occurred, the market really, really took a strong dip. It started to recover, not because the war in Iraq ended, but it had more clarity what the Americans were doing in the war in Iraq. And just that clarity alone started to have more confidence inside. So I point to another one, and this is the pandemic in 2020. So here, when the stock market went straight down, and then when there was more clarity what the government was doing, when there was a bit more clarity as to there were companies working on the problem, like COVID didn't have a vaccine when the market recovered, but the market just had more confidence in its clarity, and that's what caused it to go back up. So here is another fantastic statistic. Here's the S&P history of the last 10 worst quarters. So here's the first 5 that I want to show you. So in 87 and 08, 2002, this is where the market was down for that quarter. It was down 22% in 87, and in the financial collapse of 2008, it was down 22%. But in the next 6 months, it was up. In the next 6 months, it was up. And now I want to take 10 of the worst 10 quarters. Only 2 of them was the market still down. So that means if we use a percentage, 80% of the time when the market is coming off of a bad quarter of that magnitude, it does come back up. So here's another really nice statistic. These are historically some financial downturns of the S&P 500. Now, when I created this slide, we were in the middle of COVID. So here, when COVID hit, we were down 29.5%, and that's peak to trough. So that's like the highest to the lowest point over here. So if you look back and trace these, here we have 2000 here, and that was the tech bubble. We have 2007 going into 2008. That was the financial collapse. Peak to trough in 2008 was 56.8%. So now I take these as a historical average, and I take, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I take about 13 of these worst ones. I average them. The average is about 31.7 with a median of 27.1. So the number of days that it took to go from the peak all the way to the trough, which is the bottom, on average, about 267 days. But notice in COVID, it was as little as 18 days. And then look at the days to recover. Look at the days to recover. It was about a year. is the median average, and then a little under 2 years. So when things are bad, people think they're going to be bad forever. So the S&P 500, this is a perfect example of what causes things to go down. Financial collapses, wars, pandemics, but then consumer confidence brings it back up naturally. So right now, when I created this slide, it was just the tail end of October. Stock market was down 24%. So if you look, there is a massive amount of volatility. Standard deviation is 16.5%, and I pulled this back down to 2008. The average return is going to be about 9%. If you do a 100-year average, yeah, you're gonna fall somewhere there, but there's going to be a ton of volatility. So today, S&P 500 is as the time of this recording was it's down about 15.5%. October, which was just last month at the time of this recording, we were down 24%. Is this would you say that when the numbers are down this much, you should look to invest? My quick answer is going to be yes, because to me, I view this as a sale. There's two numbers that I'm going to have everyone kind of stick in their head, and this is what I do with clients. And remember, I'm way more of a real estate guy than I am a stock guy. But the two numbers that I want you to keep in mind for the rest of your lifetime is 20% and 30%. When the stock market S&P 500 is down by 20%, okay, it's often a time to take a larger position in it, regardless of what's happening. Well, if I just go by history, what does it tell me? It says whenever the stock market has been down by 20%, that exact number, 20%, it tends to recover somewhere between 2 and 4 years and gets back to its initial amount. So that means you're actually making a 24% rate of return somewhere between, it could be a year to 3 years. Now 30% is so basically 20% is a sale. 30% is the sale of your generation. It's the sale of the decade. It's the sale, like it rarely happens that it's down 30%. But when it is down 30% and there's a decline that fast, you're going to take a real estate guy and he's suddenly going to become a stock guy for that period of time. And 2008, we did it. And in 2020, we did it, where we allocated a large amount of money, even leveraged money into the markets. And we got these, incredible returns. We just had to wait. We essentially just had to wait. Now, am I telling you to do this? Absolutely not. Educational purposes only. I'm telling you, I'm just trying to give you some education. 20%, 30%, those are the two numbers you want to watch. So we were at 20%, and just look at my numbers. If you followed my advice at watching it at 20%, and in October of last month when it triggered 20%, if you would have followed my advice and put money inside, you already would have been up. Could it be a little bit more volatile and shake it? Sure, it can absolutely. So don't talk to me after 1 month, talk to me after 2 years, right? That's remember. And if we're down 30%, then talk to me after 1 year. So I hope this has helped. Question: should you passively invest in the stock market? So of course, the opposite of passively is actively. So I want you to think of this, I'll give you a little quiz. In the last 20 years, what was the best years to invest in the stock market? Okay, and what was the best years to invest in the stock market? So feel free to think of this to yourself. If I was to ask you, what were the best years? Okay, last 20 years, there's two years that should be coming to mind right now, and that is 2008, financial collapse, and 2020, the pandemic. In the last 20 years, the tech bubble had already passed, so we're not going to say 01. You could use the tech bubble as well, but the purpose behind that is people tend not to invest when everything is on sale because there's too much panic, there's too much doom and gloom. So then I'm going to show you this, and I've given this at many workshops before. Where would a professional buy? Where would a professional sell? So I've got A, B, C, D, E, F. Where would a professional buy? Where would a professional sell? Take a moment to think about this. So the most common answer, the professional would buy at B, right? But B is not the correct answer. And the professional would sell at E. And E, of course, is also not the correct answer. In an absolute perfect world where you had a crystal ball, of course, you'd want to buy at B and then sell at E. Now, what professionals do is they can't figure out where B is. And that's why they don't do it. Well, wait a minute. What about A, Christian? Why wouldn't they buy? Why wouldn't they buy at A? They're also not sure how far this thing is going to keep going down. So a professional, might buy at C because they know that they're near the bottom, but they're slowly climbing back up. And remember, this is very simplistic. Along that same logic, a lot of people, you don't want to sell at D, right? You won't ever know when you're perfectly at E, but you want to try to, if you're going to sell, you might want to sell at F. Now, this is, investing basics 101. Now, why would somebody not buy at C? And the answer is greed. They said, oh, I have to buy that stock at 110. Last week, I could have bought it at 90. But it could be making its big run. So because of woulda, shoulda, coulda, they don't buy it. Real estate is the exact same. So people will say, oh, Vancouver is too expensive now. I could have bought it 3 years ago for 100 grand less. So I've missed the boat. Well, imagine if you said that in 2010. Okay. So in 2010, you said, that condo, it's $300,000, but guess what? In 2009, I actually could have bought it for 250. So I'm not going to buy it because it's too expensive now. That condo is probably worth $1.2 million right now, right? Because people make that sort of irrational type of decisions. Okay. So here it says, where would a professional buy? Now I'm going to say, where should you buy? Now, because you're not a professional, the quick answer is, and again, this is just my opinion, you shouldn't be buying until you get more financially educated at any of these price points. Instead, what you should do is consider just some very, very basic dollar cost averaging. For the starter, the entry guy, the person that just wants to get started, my advice is just do some dollar cost averaging. What dollar cost averaging means is you're actually buying every single month at every single price point. Sometimes they're on sale, sometimes they're over, but then over time, they slowly keep going up until you get more financially educated, until you get more financially educated. A lot of people, they're trying to hit home runs when it comes to investments. Nothing wrong with a single, nothing wrong with a double. Stick to an investment strategy. This is what I find a lot of people do. They'll invest when it's really, really high. And then when it's really low, they'll sell out of panic, or someone said, oh, that S&P is going to continue to keep going down, get out while you can. And then they pull the money out. And then the S&P is so hot. Oh my God, you made so much money. How can I get involved? Well, you better start buying. And then all of a sudden they put money in. So they're buying at the top, they're selling at the bottom. And believe it or not, there's a lot of educated people that are probably listening to this. It happens to a lot of people. It doesn't matter your level of education. If you take a look at an index chart of multiple markets, this is the U.S. Large cap, this is US small cap, and then there's the average of the S&P, there's the bond market. Everything is on this index chart. One thing we notice about all these markets is they go up over time. So this goes back about 50 years, this particular chart. And what do we notice? It goes up slowly over time, even though there's dips along the way. So if you're not comfortable with all this volatility, you might ride the roller coaster. You might be, selling when it's low and then buying when it's high. If you just stuck to a strategy where you're just buying bits of it each time, you'd have about a 9% return. So here, just to give you a little idea of what we do here at Latitude West, we don't like the volatility. So what we do is, of course, like many other people do, we do we have something called a core portfolio. So right now the stock market was down 24 in October. I think it's down about 15 to 17 at the time of this. When we recorded this one, how did our core portfolio do against the S&P 500? When we did this in September, it was down, I think, 14. We were up 5. Nothing sexy about 5, but it's a lot better than being down. And And I think a lot of people, they think that they got to be geniuses and they got to do it all on their own. No, sometimes you just need an advisor that's got a philosophy. And I'm not saying it's going to be me, but I'm saying my philosophy is smoothing out the volatility. Right now our core portfolio is up 6. And up 6 is not bad. It's for the year. Last year it was up 12. But what I think is, when people are wondering, should I only suckers invest passively, or only suckers give their money to a financial advisor? Some people on this call right now might be doctors, might be dentists, might be lawyers, might be business owners. You're probably pretty busy to try to figure out this stuff yourself. What is the strategy that you're trying to do? And should you be doing it on your own? Or can you just, find a nice balanced portfolio, or find an advisor who's got a similar philosophy than you do? If you said, well, why don't I do a nice balanced portfolio in the S&P 500? Sure, it'll be volatile. That's the one thing. Are you okay with the volatility? Are you okay with this types of return in the long term? So our core portfolio, we're not trying to hit it at a park. We're just trying not to lose any money, and we want just solid growth rate that outpaces inflation. Now, why are we able to get such a good solid return with low volatility? I'll show you what's behind the curtain over here a little bit. 33%, 34% is in real estate. 34% is in real estate. We have less than a 50% portion in equities. We do have some bonds over here, do have some mortgages and private debt. So notice, we're going to get way less volatility because this is not showing a negative return. So that's one thing to prove it. So I kind of find the core portfolio is great for, TFSAs. I think this is a great place for TFSAs. Why? Because you might need the money and you don't want us to lose it. We're trying not to hit it out of the park. What are some things that we do to hit it out of the park? This is our long-term investments here at Latitude West. So notice I take away the fund names. These are private investments, by the way. So unfortunately, the retail investor can't get these. You can't, go to Quest Trade and then suddenly go looking for this investment. 10 years ago, you would have needed $1 million to invest in our fund. $1 million. Today, you could do it with 25 grand. As a minimum. So average ROI, we've got about 13.53. We're up to date at about 11%. So this is what I mean. If somebody said, I want some long-term investments that I want nothing to do because I want to focus on being a dentist over here, we would probably put them in our private investments and then RSP and TFSA and corporate eligible and non-registered eligible. Traditional people, they'll do a stock and bond mixture, something like 80% stocks, 20% bonds, something like that. This is the type of ROI they can expect with that ratio, about a 7%, but they still have a ton of standard deviation, a lot of volatility at about 13.34. Usually what we like to do, we like our private funds, and this is the long-term stuff, our private investment. We like our core portfolio. This is the liquid stuff. We like our estate bonds, and that over there is a different conversation. They usually work really, really well inside corporations, but we're heavy believers in direct ownership of real estate, real assets. This is stuff that you own. I don't own it. I didn't put you there. You own it. We're talking condos. We're talking, houses. We're talking rental properties. We're talking Airbnbs. Like, that's the real assets. And of course, everything I'm saying is what I preach. I practice what I preach. I own real estate. I also have money invested in long-term passive investments, as well as a core portfolio, as well as an estate bond. But when we've done our analysis, this mixture has historically outpaced the S&P 500 consistently, over time. But this brings me into a very nice transition into talking about real estate. So again, remember our business model. We not only do insurance and investments, but we do real estate advising, and we help our clients to invest in real estate as well. So now let's transition into real estate investing. This is the good stuff. This is my favorite stuff. Okay, question. What are the 3 fundamentals for investing in real estate? Okay. They are based off of, and again, you're going to see the math guy in me come out, cap rate, cash flow, and the IRR, the internal rate of return. So why should every single real estate investor understand these three numbers? It's because these are the numbers that the professionals will use when analyzing one piece of real estate compared to another. So cap rate, what exactly is cap rate? By definition, it's the net operating income divided by the market value of the property. Let's say I've got a property and it generates $4,000 a month in rent. Let's say I have monthly expenses, strata fee or property taxes or property management fee, vacancy, capital expenditures of $18,000 per year. So now to figure out the cap rate, I divide the numbers. So you take your net operating income, which is the 48,000 minus the monthly expenses, that's 30,000, and divide it by the purchase price. I'm going to snag this house out in Surrey, 1.1 million. It's got, 2 suites in it, and it's generating about 4,000 per month from the 2 suites. So what's my cap rate? About a 2.68. What do I use with the cap rate? The cap rate is used to compare against other properties. That's what the cap rate's usefulness is. It says, hey, this is getting a 2.8 cap, this is getting a 3.7 cap. Like, it's just one metric. It's not the only metric, but it's one metric. And usually areas will have different cap rates for the area. So let's say, houses in Vancouver have an average cap rate of, let's say, 1.3%. Let's say houses in Calgary have a cap rate around, 4.5%. Let's say apartment buildings in Ontario have a cap rate of about 6.3%. So different areas will have different cap rates. And if we had more time, I could show you how you can add more value by understanding the cap rate and then increasing rents and then reselling the property for like, more bang for your buck. Okay. So now let's take a look at this downtown Vancouver condo, 950,000. So we get this rental revenue, we get these monthly expenses, and we get this market value. And we said it's got a 1.64% cap rate, but you said, oh, I really, really, really would like to buy that property because it's going to make a fortune. I'm going to buy it and then I'm going to flip it and I'm going to make all this money. So what you're counting on is capital appreciation. You're counting on the IRR. I'm taking a look at the cap rate, and then of course I'm taking a look at the cash flow. Cash flow would be very, very simple. So the cap rate does not take into account the mortgage. So you said, hey, Christian, in those expenses, are you including the mortgage with the high interest rates? And the answer is no. Cap rate does not take into account. It's almost as if you're buying it outright, which is why we need our second number, and that is our cash flow. So let's take a look at this downtown Vancouver condo. It should rent for about $2,600 per month. Mortgage is about $4,400 per month. Boom. Negative $1,800 per month for this this condo over here. So we're going to get killed on the cash flow. Now, this particular slide is outdated right now. So I wouldn't say this is a 2-bedroom condo. I'd probably say it's a 1-bedroom condo. So let's pretend it's a 1-bedroom condo. So the cash flow is going to be terrible. The cash flow is going to be terrible on this. So does that mean not to buy it? Remember, educational purposes only. You need to understand that if you were to buy something like this, you are gambling only on the capital appreciation, not on the cash flow. You're only hoping for IRR. That's your play. It's definitely not cap rate, and it's definitely not cash flow. So we take a look, me and my team, we would say, hey, we're going to help to find you another property. So we find this particular property we found out of province. We look at the rental income. We look at the expenses, much better cap rate, 5.5. Cash flow is going to be about positive 600 to get 3,200 in rent. And then our mortgage minus expenses is going to be about 2,600. So what do we know? Better cash flow, better cap rate, but most probably potentially not as high IRR because its growth rate is different. So we had if you were to look, some people said, hey, what's your opinion on pre-construction, Christian? I don't have to qualify for another 2 years. I could put this pre-construction. So I'm going to use this as a case example. Not to say you should buy it or not buy it. I'm just using it as a case example. So 20% deposit, this is what me and my team would do. We would analyze it. That's what we're very, very strong at, helping our clients to analyze properties. So they come to us pre-construction. They only want 20% down, 5 now, then 10, then another 5. By the time it completes, our projected rent is going to be about $2,800 per month. in this pre-construction here in the Fraser Valley. This is not Vancouver, this is the Fraser Valley. Projecting a 5% vacancy rate, 8% property management, and 6% appreciation. That's here in Vancouver, 6% appreciation. That's probably pretty close if we do a 20-year average. I know some people said 6%, it should be 11%, 12%. You know, if we're talking to guys out of province, it'd be like 2%. We're going to average it out at 6% based off of history. So this is what we're going to find. We calculated the cap rate at a 2.9. We calculated the IRR over 20 years as a 10.74 annual interest rate. But our cash flow, negative 1,500 per month. Negative 1,500 per month. Now, can you stomach that? Can you stomach it? The answer is no. This is a bullet you might want to dodge. So does that mean, oh, is Christian saying don't buy pre-construction? Absolutely not. That's not what I'm saying. I'm saying that, one, you should analyze these numbers. And if you don't know how to do it, you should be working with an advisor who knows how to do it, right? So when we break this down a little bit more, what was our interest rate? 5.25 on a 750, 20% down payment. We put in closing costs, we put in vacancy rate, we put in all of those other things. And here's the thing that we want to know. What is our IRR? Now, this isn't such an easy number for people to calculate on their own. They can calculate cap rate on their own. They can calculate cash flow on their own, but can they calculate cap rate on their own? IRR on their own? Probably not. So we calculate IRR depending on the year that it was sold. So if you said, I'm going to sell this thing in year 10, your IRR is about 12.87. But the problem is your cash on cash return is negative. Your cash on cash return is negative because the only thing you're counting on is, of course, the capital appreciation. So what will make this deal look a little bit better? Higher down payment. You can improve the numbers with a higher down payment. So now we're putting 35% down payment. And the reason why I did that, I needed to play with the numbers until I got a break-even cash flow. So if a client said, I absolutely want to buy that pre-construction, but I don't want the negative cash flow, the answer is, put more of a down payment in, put more of a down payment. So at 35% down, at least I can get this thing to break even. And then I would also say, okay, I'm going to help you to get this thing, because maybe we should look at not doing it as a long-term rental. Maybe we should look at it as a corporate or as a short-term rental like Airbnb. This place did not qualify for an Airbnb, but it does qualify for a corporate rental. If you're not even sure what that means, by all means, give me a call and then I'll explain what that means. So we set them up with a corporate rental, generated about 30% more in monthly income, got this thing to cash flow. But look, the cap rate got better, 3.91. The IRR got worse. Why would the IRR get worse? Because you put more capital into it. So now, of course, your money is it has to, the amount that you get afterwards is also based off of the amount you put in. Because you put in more, your IRR gets worse. So we look at this one, at least our cash on cash return is a little bit better, but our IRR got worse, okay? So would I say these are home run investments? I'd say absolutely not. Christian, can you show us some examples of some home run investments that you and your team have done for your clients? Absolutely. Please don't ask me where they are. I've removed the addresses on purpose. Okay, so I'm going to take a look at this house out of province. It got about $2,300 a month in cash flow as a long-term rental. But of course, with our expertise, we were able to rejig the house, turn it into a bit of student housing, rented the units off individually, set them up with the property manager. Now we're getting $3,450 per month on a $450,000 house. There was some capital expenditures to throw in because we had to do a couple of renovations to it. Let's take a look at the numbers. 7.2% cap rate, outstanding. 21% IRR. No stock is going to get you a 21%. I'll tell you that consistently over 20 years. $900 a month in cash flow. This is a home run. This is a home run. This is what our clients, come to us for. Let's look at another home run. Again, I'm not going to put the address on it. This is an Airbnb condo in a Canadian city outside of Vancouver. It costs about $350,000. It is Airbnb approved, this condo. We're going to get about $165 a night in short-term rental. Super expensive strata, $569. We're going to do a 20% down payment and Our property manager takes 30%. Sorry, property managers on Airbnbs take about 30%. Latitude West has got a relationship with a property manager. What they will discount it because we have so much volume at 20%. So that, of course, is going to improve your IRR. Let's take a look at the numbers here. $681 per month cash flow, 7.2% cap rate, and almost a 20% IRR. This again would be considered one of our home runs over here. Okay, so to summarize it, these are the three numbers that I wanted to teach you guys. These are the three numbers that I wanted you to see: cap rate, IRR, and cash flow. Whenever you're investing in real estate, these numbers should always be calculated before you actually buy the investment, so you know what you're getting into. Okay, so the breakdown of this guy, we're in the double digits. We're absolutely in the double digits over here. So this to me is why institutions like the Canada Pension Plan, like the Tiger 21, this is why they're able to generate consistent double-digit portfolios. The reason why these numbers are also so high, of course, is because the leverage that we spoke about off of the bank money. So of course, they're not as easy just investing in the stock market. You of course do have to there is more steps than just investing money in the stock market. Okay, let's transition to the next one. How can you determine your return on investment for a real estate purchase? So this is a little bit more math over here, but I kind of want to show you a bonus why I invest so much in real estate and why I teach my clients why they should be open to the idea of investing more in real estate. So here's the math. Expected long-term values. Let's take a $625,000 piece of real estate. If after 5 years you assume zero growth, assume the rent is equal to the operating expenses, what are the possible future values in 25 years? So the answer, like every single region has a different growth rate. So me and my team, we investigate the growth rate before our clients make a purchase. If it's, in the prairies, it might have a 2% growth rate on a condo. If it's a house, it might have a 4%. If it's in Vancouver, it might have an 8%. So it always depends on the growth rate. So I'm going to show you a bit of a sensitivity analysis. So I'm going to use a financial calculator here. $625,000 investment, depending on what our growth rate is, but we're going to go 25 years later. So at 2%, that 625 will be worth 1 million. At 4%, 1.6. At 6%, 2.6, and at 8%, 4.2. So why am I showing this? The growth rate matters. The growth rate matters, and this is why so many people invest in places like Toronto and Vancouver, because they want that high kicker of the growth rate. I love the high kicker of the growth rate. I just don't want to be bleeding to death on the cash flow. So I need to, combine the two together so I have good growth rate and good cash flow. So what is my new ROI over here? So remember, let's say I put a down payment of only $31,250. Okay. And we got the cash flow to break even. So the rent covered the mortgage. Okay. My future values. Okay. I'll take my future values again. But now what I'm going to do is I'm going to now take my down payment and figure out what is my IR, what is my rate of return, my ROI on it. So on the 2%, I get a 15% rate of return. On the 4%, I get a 17%. On the 6%, I get a 19%, and on the 8%, I get a 21.75% rate of return. So whenever people sort of say how we help our clients get double-digit returns, they're always wondering, well, how do you do that? It's mostly because of the real assets that they end up buying, and we show them based off of their down payment what is the type of return they're going to get. This is the exact same thing CP Canada Pension Plan will be doing. This is the exact same thing the Tiger 21 will be doing. So the question is, why aren't you doing this, right? Why aren't you doing this? So you're of course going to get a higher return the lower the down payment. Then we can, start talking about, well, what if you joint venture? If you joint venture, you're putting in nothing. Like your rate of return is going to be incredibly, incredibly high, and what are infinite returns? That's for another conversation, but yes, it is possible to get infinite return, infinite ROI, but that's for a conversation for another time, unless you want to book a meeting and talk with me. Okay. So here's my bonus. This is the bonus I kept telling everybody about. And this is why I own multiple rental properties, and also why I encourage you to own multiple rental properties as part of your portfolio. Okay, so let's pretend you have an initial rent of 2,000, 2,500, 3,000, something like that, okay? Now, let's say that the rate of growth on rent is 3%, which is about right. In some areas, it's even more. How much rent will you be getting in 25 years? Let's say the property is, is yours in 25 years, you completely bought it out. Your $2,000 a month in rent is now 4,187. Your 2,500 in rent is now 5,234. Your 3,000 rent is 6,281. So remember, why is cash flowing rental property so great as a retirement vehicle? It's because you can't outlive that rent. Whereas your RSPs and TFSAs, you could outlive that. I have $1 million in RSPs, but now I have to start siphoning off of it. Is it possible for me to live so long that it depletes down to zero? And the answer, of course, is yes. It is possible. If you own properties inside your retirement and you don't sell the properties and you're receiving rent, cash flowing rent, is it possible to outlive it? And the answer is no. You're going to get this and it'll keep increasing after year 25. So if you live for another 25 years into your retirement, 65, that'll put you at age 90, right? This rent just keeps coming in and keeps getting bigger. Whereas typical people in retirement, their assets get smaller as they get older. Real estate guys, their assets get bigger as they get older. Okay. Now, what about this as an estate inheritance for the children? Assume the property was bought at age 30, held until life expectancy age 85. So what is the future values of those rents 45 years after you bought it? 45 years after you bought it. It's now 7 grand, 9 grand, and 11 grand. So can you imagine passing on to your children one asset that's worth, millions of dollars plus has got a $11,000 per month future value in rent. Of course, I haven't taken into account inflation. That's for another math lesson, but it's still an enormous amount that now they can't outlive either, right? So that's one of the great reasons why my practice loves real estate, why we encourage our clients and teach our clients to invest in real estate, and we help them to find real estate if they can't find great cash flowing properties on their own. Okay. So why invest? Well, you got these tax advantages, you got the cash flows, sheltered capital gains, which we don't have enough time to go over. What are the downsides? Is it really that easy? And the answer is it's not that easy. There's vacancy rates, there's capital expenditures, there's bad renters, it's time consuming versus traditional stock investments. So does this have a location for you? The answer is maybe. Are you working with the right advisor that can help you? If the answer is no, maybe we should talk. But like I said, educational purposes only. Okay. So what does a traditional portfolio look like? Like I said, you got stocks, you got bonds, and you're going to get this okay rate of return with a bunch of volatility. What does our philosophy look more like? We want a mixture of everything. We want not whatever is going to be passive. We don't want, we like stock exposure. We don't like stock reliance. Stock market crashes, we want to still want to sleep well at night because we know we've got this long-term real estate that's driving the numbers forward. Okay, I want to transition now into business ownership, and this is my last topic. So this is for people who are thinking of starting a business. This is for people who are maybe a dentist and they're thinking of opening a practice. This is for a physician who's thinking of starting a clinic. So a couple of things that you want to consider. One is the timing right. What is this decision based off of? Hopefully it's not ego. And are you okay with the salary change that's going to occur? So when we talk about buying a practice, here are some fundamentals, okay? If you are thinking of buying a practice right now, and I'm just going to use an example of a dentist. So if you're a dentist and you're listening, this example is for you. If you're considering buying a practice, what is the first step? Okay. So for my MBA days, we will do a quick SWOT analysis, and that is what are your strengths, weaknesses, opportunities, and threats. Okay, so I think a lot of people a lot of dentists end up buying a dental practice, and I feel about half of them are suited for it and about half of them are not. And that's a pretty number when half of the people are buying a dental practice, but they're probably not suited for it. So let's do a quick little SWOT analysis. If you're thinking of buying a dental practice over here, what might be your strengths? And here are some that you might have. You've always wanted to own a business. So if you're scared of owning a business, then remember, you should potentially not be buying one. Maybe you enjoy dealing with people because a business owner is going to be a people person. They got to deal with staff. They got to deal with upset, patients. They got to deal with vendors. They like solving human relation problems over here. They're ambitious to earn more money. You can earn significantly more money if you're buying practice. You might have you buy more than one practice. Maybe you've got a bit of a business background. And maybe you're eager to do something aside from just the dentistry itself. Okay, so those would all be considered strengths. What are some weaknesses that we want to be really, really careful of? Maybe you lack a lot of business knowledge. Maybe you actually don't like dealing with people. Maybe you're really bad with numbers, nervous to start a business, dislike debts. Usually, typically, when people start a dental practice or a medical practice, you have to borrow this money from the bank, or you have to use the owner as the bank, where you're consistently paying them back. If you're so nervous over your whatever $300,000 of student loans, how nervous are you going to be over your $1.5 million business debt that you have to pay off in 7 years, right? So that might be your weakness. That it's whatever your weakness happens to be, it's important to identify it early. But then opportunities, what are your business opportunities? Maybe you're inheriting a practice. Maybe your parent, your father or your mother or your uncle is actually saying, you can take the practice over. I'm a dentist and you're a dentist and you can take the practice over. Other advantages might be, you speak Croatian, you speak Mandarin, you speak, Farsi, and you feel that this is an opportunity because in that area of your community, you're already ingrained there and the people know you, or there's an area that you're going to go into. That would be considered an opportunity. You might say, there's a lot of dentists in my family, a lot of people I could use as mentors. That's another opportunity. If you said, you know what, I'm willing to relocate, I'm willing to go into these areas of rural areas where they don't have as many dentists, that's another opportunity. Somebody who's very eager to learn. So what are some threats to you being successful as a dentist or owning this practice? Okay, let's say you're just at the wrong stage of life. Let's say you're just about to get married, you're about to have kids, and are you willing to, take on this massive endeavor? Is it the right time? Maybe your history as a, business owner, as someone is not great with follow through. Maybe all of your current debts, the high stress of your debts, is also causing it not to be the right time. Okay, and maybe, in and of itself, you're just not great under pressure. When you transition to a business owner, it really is taking on a new hat, on a new role, and you got to be really transparent about how you are with, anxiety, how you are, when you're an associate, you do your job, don't screw up, go home, tune out, watch some Netflix. When you're a business owner, every single problem comes with you. Fridays are typically the days you deal with all the problems. Okay, I gotta, deal with the vendors. I gotta deal with the complaints. I got staff to manage. So there's all these different issues where it's like just a dentist, an associate doesn't have to deal with them, right? So, if you were considering, starting a practice, this is where my starting point would be. So, for those people who are in that position, I suggest where to start. Build a team around you. No one ever did it alone. Get a good accountant, get a good financial advisor, get a good lawyer. And then the fourth one, and I think a lot of people forget about, get good mentors, get good mentors. One of the great things about us here at Latitude West is we're kind of like a full service, all one stop. If you needed a good accountant who specializes with medical, dental, business owners, we have multiple accountants that would do that. firms, also lawyers. And mentors, we're able to actually pair you up with mentors. I don't think a lot of other organizations are able to do that. I like when I pair people up because it allows them to learn more off of something that I can't teach them or I can't advise on. Mentorship is huge. I would never start a business unless I had some key people that I could lean back on when I had those big questions. And I think when people just try to do everything on their own, that's when they get into the most trouble. That's where all the trouble starts. So we're going to slowly start to wrap this up. Should you be using advisor? I think everyone needs the right advisor. I'm not saying I'm the right advisor for you, but I'm saying that everybody does need the right advisor. The people of my practice, a very, very mature practice, close to 800 clients, they rely on me very, very heavily for different reasons. Someone want business advice, someone want real estate advice, someone want, just basic cash flow, retirement advice. But I know that the value that a good advisor brings is going to multiply your wealth. I guess that, again, I'm not saying to use me, but I think the strongest thing is you want the right advisor to help you to multiply your wealth. Because if you do try to do it completely on your own, statistically, according to this statistic, you won't go as far as if you do it with the right people. So now, if there are any questions, now is the time. You could put it in the chat. Faisal, if you are there as well, you can help me to field questions, or Faisal, maybe you have some questions on your own. I know I went through everything quite quickly. I wanted to do that in order to make sure that I got through all the content. I am recording this session if anyone would like to do a sort of a review with it. So if there's any questions, throw it in the chat. I am absolutely more than happy to field it. Faisal, how are you doing?
Christian, good. Thanks. I appreciate you going through that. I'll quickly just, I'll talk about my reflection about some of the things you mentioned. I want to kind of go from the back to the front, but it's so important. I think what you mentioned is it's not just about the numbers, right? The qualitative stuff matters. You have to match kind of your risk tolerance as an individual and be very understanding about your purpose and your strengths and weaknesses before making some of these decisions. So I appreciate the fact you went into that. That doesn't only apply to owning a business, but same, like you mentioned, whether it's investing in real estate or investing in stocks, you really need to understand yourself before you can make these decisions, or work with a trusted partner who's able to guide you based on, the relationship that you've built. I think it's very interesting. We're in a decade now where, we're at the highest interest rates in a decade that we've seen. And I'm curious to know, you can either answer from a real estate perspective or even from a, buying a practice perspective, like a dental office. What are your thoughts on the current economic climate, and what would you advise to individuals given where we're at in the economy?
Yeah, that's a good question. Everyone's got the high interest rates on their mind right now. And then clients are always asking me, is now a good time to buy real estate? Shouldn't I hold back because the interest rates are too high? When for those of you old enough to remember the 80s, the interest rates were double digits. They were 12, they were 18, and then they peaked at 22. In the 80s, they would have killed for a 5%. That would have been a Christmas time to them. Man, it's 5% interest rates. Oh my goodness. The historical average is about 7.2%. The Canadian historical average, 7.2. So we're still underneath the average, I care a lot about cash flow. So if somebody said, I'm thinking of making an investment in a dental practice, I'm thinking of making an investment in a piece of real estate, I would look very, very carefully at cash flow based off of the rates that you're getting. Does it make sense? Can you afford it? So does the cash flow make sense? Then I would look at the property itself or the dental practice itself. If it was a dental practice, I would say to myself, can I add value? If it was a rental property, I says, can it maintain its value or can I add value? Then it would help me to calculate the IRR. I'm one of those guys that to use a baseball analogy, I want you to imagine that you're a baseball player, a major league baseball player, and every single time you went up to bat, you're trying to hit a home run. Every single time you're trying to hit a home run, right? Would you ever be in the Hall of Fame? And the answer is no. You'd actually probably get dumped down to the minors pretty quickly if every single time you went to bat, you tried to hit a home run. Guys who get up there, they try to hit singles, they try to hit doubles. You know, if it's perfect pitch, sure, a home run. So let's talk about stocks. Let's talk about real estate. Should I just be consistently buying? And the answer is yes. You should, as soon as you've got cash, you should be consistently in the markets. As soon as you got cash, if you're a real estate guy, you should be consistently buying. It's in bad markets, it's harder to find good deals. Absolutely. Does that mean I should take a pause and not be looking and not be investing? And the answer should be absolutely not. Oh, but it's high interest rates. Find something that cash flows with those crazy interest rates. So quick comment on the interest rates. We do a very, very deep dive analysis as to what the economists are saying. We believe the interest rates are going to continue to be high into 2023, Q1, Q2, Q3. So we actually think they're going to be higher, then we believe that they're going to level off. If the inflation rate goes below 3%, which is what the federal government is trying to do, they're predicting end of Q4 of 2023. That will be the first signs of a lowering of interest rates. So when people are saying, should I go fixed? Should I go variable over here? I don't have a crystal ball, but doing a variable, if you're okay with a bit of a bumpy ride, but in the long term, it could end up going back down and it could be in your favor. Remember, people who go variable 90% of the time are better off. We happen to be in the pocket of the 10% where you were better fixing your rate last year than you were going variable. I don't have a crystal ball, and I'm not telling anybody to go variable, and I'm not telling anybody to go fixed, but I'm giving you the math behind it. I think doing something, you know, if you believe that the variable rate will come back down, which I do personally, then you might want not to lock in for such a long period of time over here. And if your stomach can handle the cash flows, the cash flow on the high interest rates, you might even just want to stick to variable, you know. So that's my view. And remember, I've had interest rates as high as 6%, and there's no regrets. It's not like I wouldn't have bought it then. I bought 2 properties last year. Interest rates were over 4%, I believe. I'm looking to buy more properties now. My interest rates are in the 5%. I just care more about the numbers. I don't really care about the interest rate. It's just one more number I'm factoring in. Yeah. Was there any other questions? Or Faisal, did you have any other questions?
Well, I was going to ask the same thing. I don't know if Graham or Janina have any questions. If not, we might be right towards the end of the time, but
yeah, no problem. So, what I'll do over here is I'll just remind people what our process is. We always start with a discovery meeting, and our discovery meeting is always complimentary. It's more just a collection of information. You know, the purpose of this webinar wasn't to try to sell you something, sign a client, convince you to buy a stock, convince you to invest with us. No, the purpose of this webinar was just to educate, you know, just to get you familiar with what me and Faisal and what our team is able to do and how we're able to help you. We invite you to our next one. You know, when we're going to do this again, we're still experimenting with a hybrid model. I think it's the cold and flu season right now, and COVID is still lingering. Nobody wants to get sick during this time. So, we kind of stick to webinar. We'd love to see people in person. We'd love to talk to people if they just want to talk. There'd be no expectation on our side except to help you. That would be it. Okay. And I think Faisal and I are pretty nice in that way, that we're happy we're happy to slowly build the relationship based off of trust. And when you're ready, and if you ever want to do anything with us, then we just invite you to do so, and it would be our privilege to help you. Right? So if you did want to connect, my assistant is usually the best way. If you have Faisal's direct contact information, feel free to connect with him. If you want to connect with me, if you had any follow-up questions, anything like that, just reach us. And then if anyone wanted to talk, that's how you get in touch with us. But I think I am an hour and 15 right on the button. I want to, again, thank everyone for coming. Faisal, thank you for providing your wonderful questions. And as always, I wish everyone a great rest of the day, and stay safe out there. Have happy holidays. And I hope I was able to give some form of value in today's session for you guys over here. Okay. Sorry about that. All right. Talk to you guys soon.
Thanks, Christian.